Good morning. My name is Grant Sporer. I'm head of the EMEA Metals and Mining team based here in London. And as part of our mid-year review of the precious metals sector, I will take you through the outlook for the Platinum Group metals, or PGMs, for the second half of 2022 and into 2023. In short, we believe the outlook is somewhat muted, as well-established drivers exert a strong influence over the market in the next 6 to 12 months. That said, there may be some upside risks in the near term, but we see any metal price rallies as being short-lived. The two main PGM markets, platinum and palladium, are going through an extended phase of rebalancing. And by that we mean the large deficits between supply and demand in palladium that have been present for nearly a decade are shrinking, such that the market could be in balance by 2023 or 2024. Before moving into a big surplus by the end of the decade. In contrast, platinum's decade-long industrial surpluses may be shrinking, and the market could be moving into a small but meaningful deficit by the middle of the decade. The drivers for palladium are threefold. Firstly, a substitution of the metal in favor of platinum in gasoline autocatalysts. Secondly, palladium supply could increase by nearly 3 to 4% per annum over the next few years, mainly due to secondary metal from recycled autocatalysts. And lastly, the sharp rise in battery vehicle sales at the expense of the internal combustion engine means that palladium demand could be nearly 10% lower by the end of the decade. The drivers in contrast for the platinum market are, firstly, its low price and its varied uses across a number of in-demand sectors, which means the metal can effectively compete with substitutes across the board. Secondly, the supply response has been slow as miners have been hampered by a number of operational issues and challenges, not least the hangover from COVID-19. And lastly, the emerging hydrogen economy could become a 1 million ounce per annum demand source early in the next decade. To complete the picture for PGMs, we need to talk about rhodium. It's a byproduct metal that makes up 5 to 7% of the basket of metals a typical Southern African miner would extract. But the metal has had a hugely positive impact on the economics over the past 2 years, with the price rallying from $2,500 an ounce at the beginning of 2019 to nearly $30,000 an ounce in the first half of 2021. The metal is a bit of a one-trick pony, but its key superpower is its ability to reduce NOx, or nitrogen oxides in tailpipe emissions, which is a key focal point of tightening legislation globally. However, even at $1,400 an ounce, the price is elevated by historical standards. So the combination of thrifting and a falling internal combustion engine market share means that demand could ultimately fall, and the market could be in a surplus by the middle of the decade. The net result, though, of an improving platinum outlook, but a weaker palladium and rhodium outlook, is a lower price for the basket of metals that the miners extract, and that's particularly in our market rebalancing scenario. Focusing on the short term, we would point to two upside risks over the next 12 months. The first is pent-up auto demand. Should these bottlenecks be resolved in the auto supply chain before consumer spending is upended by a weaker global economy, there could be some near-term upside for PGMs. The supply side also has a degree of fragility. So far, protracted strike action in South Africa from a series of labour negotiations has been avoided, but rolling power blackouts pose a risk to between 55 and 65% of platinum and rhodium supply. That's good for metal prices, not necessarily for the individual miners. While fears over Russian supply disruptions have been overblown, a lack of equipment and spares could hamper Russian output over the medium term, and that particularly impacts the palladium market. So where does this leave the PGM miners themselves? Earnings momentum for the Platinum Group miners is likely to remain negative as the basket price continues to fall, with inflation compounding the falling top line. And squeezing Ebitda margins by between 5 and 14% over the next 12 months. Consensus estimates have yet to factor in softer metal prices and higher inflation according to our analysis, and we expect to see some earnings downgrades. That said, valuations are already well below mid-cycle averages, already reflecting a weaker metal price environment, with a sector EV to EBITDA of 3.4 times, well below the 10-year average of 6.7 times. The miners have built up cash on their balance sheets, so while dividends may be cut as earnings and free cash flow fall, capital plans could continue unimpeded. In a falling metal price environment, Anglo American Platinum, or Amplats, looks well positioned to us with its low-cost operations able to defend margins better than some peers in the industry. The competitive bidding situation for Royal Bafokeng between Impala and Northam could also play out over the next 6 to 12 months. Impala is the natural owner with contiguous properties, enabling them to extract synergies out of the acquisition, also securing the longer-term future of the Rustenburg lease area. So, in summary, the sector is well positioned for a falling metal price environment and does enjoy a degree of valuation support. But peak earnings are behind us, with consensus still having to play catch-up, leading to this rather muted outlook for the second half. Thank you very much.